Australians are earning more than they ever have before, and somehow they're getting poorer. That's not a contradiction. It's the reality of the Australian economy in 2026, and the numbers behind it are staggering. For years, the advice was simple. Save what you can, invest when you're ready, and let time do the rest. But that mentality doesn't hold anymore. Inflation has been quietly stripping value out of every dollar sitting in a savings account, and holding cash, once considered the safe option, has become one of the more costly financial decisions a household can make. Being exposed to the market isn't a lifestyle choice anymore. For a lot of people, it's becoming a necessity. Think about that for a second. Wages have technically risen. Employment, until recently, stayed remarkably resilient. And yet, survey after survey shows household stress climbing, not falling. The disconnect isn't a mystery once the inflation numbers are laid side by side with income growth. It's arithmetic. When prices rise faster than take-home pay, the extra dollars in a payslip buy less than they used to, even while the number on the page looks bigger. That's the trap so many households are caught in right now, and it's exactly why understanding where the economy is actually heading, not where it feels like it's heading, matters more than ever. So what does the data actually say? Start with growth. Gross domestic product, the total value of everything the economy produces, rose by just 0.3% in the March quarter of 2026. That's a sharp slowdown from the 0.9% recorded the quarter before. According to KPMG's Economic Outlook, growth is expected to stay weak throughout the rest of the year as persistent inflation and tighter financial conditions following 3 Reserve Bank rate hikes earlier in 2026 continue weighing on households and businesses alike. This isn't a one-off soft patch, it's shaping up as a pattern. And it raises a genuine question worth sitting with. How much of the growth Australians keep hearing about is actually lifting living standards, and how much of it is simply population growth propping up a headline figure? Then there's unemployment. The jobless rate climbed to 4.5% in April of 2026. Deloitte Access Economics currently forecasts it averaging around 4.9% across 2026 and into 2027, with the possibility of it peaking near 5% in 2027 to 2028, before easing slightly as inflation cools and rate cuts, if they arrive, start to stimulate the labor market again. That's not a dramatic spike on paper, but after years of one of the tightest labor markets in decades, even a modest deterioration changes the conversation for wage growth, for consumer confidence, and for what the Reserve Bank does next. Inflation is where things get genuinely complicated. Headline inflation sat at 4% in May 2026, easing slightly as fuel costs came down. But underlying inflation, what economists call the trimmed mean, which strips out the most volatile price swings, actually accelerated to 3.6%. That's still well above the Reserve Bank's own 2 to 3% target band. Deloitte's current forecast has headline inflation remaining above 4% for the remainder of the year, with underlying price pressure not expected to peak until early 2027 before gradually returning to target sometime in 2028. That's a forecast, not a guarantee, and there's a real possibility inflation could collapse faster than the models suggest if the broader economy tips into a genuine slowdown. Weaker demand has a way of cooling prices faster than any spreadsheet predicts, which brings the conversation to interest rates. The Reserve Bank's cash rate now sits at 4.35%, following 3 increases already this year, in February, March, and May, up from 3.6% at the start of 2026. Some forecasters, Deloitte among them, still expect one more 25 basis point rise in August, followed by an extended pause, with actual rate cuts unlikely before late 2027. Other bank economists, including those at Commonwealth Bank, expect the Reserve Bank to hold steady for the remainder of 2026, with 2 rate cuts penciled in for 2027 instead. Nobody's certain, and that disagreement between forecasters is itself telling. But here's some historical context worth remembering. During the depths of the pandemic lockdowns, the Reserve Bank slashed the cash rate all the way down to 0.10%, a record low. If a genuine recession does take hold over the next couple of years, cuts on that scale are not off the table. Zoom out, and the broader picture looks even more fragile. Growth in the March quarter slowed sharply. Global pressures, like the spike in oil prices tied to conflict in the Middle East, have added extra strain on households, even as that particular impact starts to fade. Consumer confidence has stayed low, and it's likely to remain there for a while yet, because household budgets are being squeezed from multiple directions at the same time. And the rental market tells its own story. National rents rose 5.5% over the year to February 2026, with regional areas seeing a 6% jump, outpacing the 5.3% increase recorded across the capital cities. For renters already stretched thin, that isn't an abstract statistic on a chart. That's next month's bank transfer getting bigger again. Household financial conditions have followed a similar path. Earlier in 2026, conditions were still broadly expansionary, but as the Reserve Bank pushed through its rate hikes, that expansion has started to fade. Mortgage repayments have climbed, fuel costs have risen, the labor market has softened, and the savings buffers many households built up over the past few years are gradually being drawn down to bridge the gap. None of this is catastrophic in isolation, but together it paints a picture of households with materially less breathing room than they had 12 months ago. Mortgage holders, in particular, are showing the clearest signs of pulling back on discretionary spending, according to recent household spending data. Travel, dining, and entertainment are the first categories to feel the squeeze when a budget tightens. Renters and outright owners have so far held up a little better, but that gap between household types is worth watching closely because it tends to widen further before it narrows. So, in an environment like this, why would anyone put money into the market at all? Here's the uncomfortable truth. Holding cash is a losing long-term strategy. Inflation erodes the purchasing power of money sitting idle, year after year, quietly and relentlessly. When uncertainty rises, people flock to cash because it feels safe, but that peace of mind comes at a real cost, paid in lost purchasing power that compounds in reverse just as powerfully as growth compounds forward. This is exactly where a contrarian mindset becomes valuable. Historically, downturns and periods of low consumer confidence have often turned out to be some of the better buying windows available, not because risk disappears, it doesn't, but because assets get repriced while fear is high and competition for them is low. That takes mental preparation, expecting short-term paper losses and refusing to panic sell into them. It's one of the clearest differences observed between wealthier, more experienced investors and those who hesitate. The experienced ones have simply lived through enough cycles to trust that they eventually pass. That doesn't mean ignoring risk, it means separating genuine risk from discomfort. A falling market feels risky in the moment, but sitting entirely in cash while inflation quietly erodes its value carries its own risk too. It's just slower and far less visible, which is exactly why so many people underestimate it. The investors who navigate downturns most successfully tend to be the ones who've written down their plan in advance before emotions take over, so a bad week in the market doesn't turn into a bad decade of decision-making. There's also a structural difference worth understanding between shares and property when it comes to liquidity. Buying shares doesn't require lender approval. An investor can act the moment they decide to. Property is different. It requires financing, serviceability testing, and lender sign-off, all of which slow things down. Call it the liquidity tap. When credit conditions eventually loosen again, the investors who moved early, before competition returns and prices catch back up, tend to benefit the most. Waiting for total certainty before acting often means arriving after the best opportunities are already gone. So where does that leave things? The core takeaway is simple, even if it's uncomfortable to sit with. Acting counter to the crowd during periods of uncertainty has historically rewarded the people willing to do it. There's no guarantee borrowing capacity will still be there once confidence fully returns. Rates, lending standards, and asset prices can all move well before that happens. The data paints a picture of a slowing economy, a softening job market, and inflation that hasn't fully been tamed. But within that same data sits a case for staying engaged with the market rather than retreating from it. History doesn't repeat perfectly, but often enough it rhymes. And for those paying attention, that rhythm is worth listening to.